Welcome back to the channel. What you're about to hear could completely reshape everything you thought you knew about the British property market. Because in just the last 72 hours, the mood inside Downing Street has shifted from cautious concern to full-blown alarm. This is not exaggeration. This is not clickbait. House sales across the United Kingdom have fallen off a cliff, and the speed of the drop has stunned even seasoned analysts who lived through the crash of 2008. The ripple effects are already being felt by landlords in Manchester, first-time buyers in Bristol, pensioners in Cornwall, and renters in every major city from London to Leeds. If you think this doesn't affect you, think again. The Prime Minister is facing mounting pressure as transaction data paints a bleak picture. Emergency meetings have reportedly been held in Number 10, Treasury officials are scrambling to revise forecasts, and housing briefings have jumped to the top of the political agenda. Why? Because when housing slows in Britain, everything slows. This isn't just about property prices. It's about tax revenue, jobs, banking stability, and consumer confidence. Let's break down what is actually happening. Completed house sales compared to the same period last year have dropped dramatically, with declines not seen since the financial crisis. Estate agents are reporting that viewings have dried up. Offers are being pulled at the last minute. Chains are collapsing days before exchange. And here's the part the mainstream headlines aren't emphasizing enough. The official data always lags reality by 6 to 8 weeks. That means what you're reading in the papers today reflects decisions made nearly 2 months ago. On the ground right now, many professionals say it's worse. New listings are rising, but buyer inquiries are falling sharply. The gap between asking prices and final sale prices is widening. Sellers are reducing expectations. Buyers know they hold the leverage. Negotiations that once would have been laughed off are now being seriously considered. If you're selling, you're competing against a growing pile of other properties, and many of those sellers are increasingly desperate. But here's what's really causing panic in Westminster. It's not just falling prices, it's the collapse in transaction volume. Every time a property changes hands, stamp duty flows into the Treasury. Fewer sales mean less revenue, and that revenue was already baked into public spending plans. Billions of pounds are at stake. At the same time, the construction sector, which employs hundreds of thousands across Britain, depends on a healthy property cycle. When transactions stall, developers pause projects. Planning applications slow. New builds are delayed or cancelled. Jobs become vulnerable. Then there's the banking system. British banks collectively hold roughly £1.5 trillion in residential mortgages. As long as prices hold and employment remains stable, the system absorbs stress. But if prices fall significantly and unemployment ticks up, default risks increase. We are not in crisis territory yet, but policymakers are watching very closely. The trajectory matters more than the current snapshot. So what triggered this? First and most obviously, mortgage rates. During the pandemic years, buyers locked in ultra-low rates. Some secured deals under 2%. Today, average mortgage rates are roughly double what they were 3 years ago. Even if rates have eased slightly from their peak, affordability has been fundamentally reset. A typical £300,000 mortgage now costs hundreds more per month than it did not long ago. Add rising council tax, higher energy bills, and general cost of living pressure, and many households simply cannot stretch further. But here's the twist that's freezing the market. It's not just first-time buyers stepping back, it's existing homeowners. The so-called move-up market has stalled. Homeowners sitting on 1.5% or 2% mortgages look at current rates and decide not to move. They don't want to swap a cheap loan for an expensive one, so they stay put. That decision makes perfect sense individually, but collectively it creates gridlock. Fewer homes come to market, fewer chains form, fewer transactions occur. The engine of the housing market slows to a crawl, and when transaction volumes collapse, the entire ecosystem feels it. Estate agents rely on commission, mortgage brokers depend on applications, solicitors earn from conveyancing, surveyors, removals firms, home improvement businesses, all are affected. This isn't a niche slowdown. It spreads outward through the economy. First-time buyers might think falling prices sound like opportunity. But here's the reality. Even if prices fall 10%, high interest rates can wipe out that benefit. Monthly payments remain elevated. Lenders are stress-testing borrowers more aggressively. High loan-to-value products are limited. 5% deposit deals are harder to access. Even 10% deposit buyers face higher costs than they would have just 2 years ago. In some cases, buying today means paying more per month for a cheaper property. Landlords face a different storm. Tax changes over the past few years have reduced profitability. Regulatory burdens are increasing. The looming reforms around tenancy rules have added uncertainty. Many landlords are choosing to exit. But here's the unintended consequence. The properties they sell often leave the rental sector entirely if purchased by owner-occupiers. That shrinks rental supply at the exact moment demand is surging from would-be buyers who cannot afford mortgages. The result? Rents continue climbing. In many cities, rental listings receive dozens of applications within days. Prospective tenants offer months up front. Competition is fierce. The sales market is weak, but the rental market is overheated. It's a strange and painful contradiction. Pensioners hoping to downsize are also caught in the crossfire. Selling larger homes is harder because families cannot afford big mortgages. Meanwhile, smaller, desirable properties face competition. Retirement plans built on releasing equity are being delayed. Some older homeowners remain in properties that no longer suit their needs, not by choice, but by circumstance. The government's options are limited. Cutting stamp duty reduces Treasury income. Pressuring the central bank on interest rates risks credibility and inflation concerns. Introducing large buyer subsidies risks inflating prices again. Planning reform faces political resistance locally. Every lever carries cost or controversy. That's why the mood is tense. Regionally, the story varies. Some London markets are particularly slow, especially at the higher end. Prime areas once driven by international demand are quieter. Certain commuter towns are more resilient due to hybrid working patterns. Some northern cities with more affordable price-to-income ratios are holding up better. Scotland and Wales each have unique dynamics shaped by different regulations and policies. The UK housing market is not one single entity. It is dozens of local markets moving at different speeds. So what happens next? One possibility is that inflation cools faster than expected, allowing interest rates to fall meaningfully. That could improve affordability and revive transactions. Another scenario is prolonged stagnation, low volumes, slow price drift downward, and years of sluggish movement. The worst-case scenario would involve rising unemployment or an external financial shock triggering sharper price declines and confidence loss. That risk exists, but it is not inevitable. For buyers, patience may be power. There is no frantic rush like during the pandemic boom. Time and negotiation are on your side. For sellers without urgent need, waiting might preserve value if rates ease. For landlords, detailed financial analysis is essential. For renters, stability and careful budgeting are critical in a competitive market. What makes this moment historic is not just falling numbers, it's the shift in psychology. For decades, British housing operated on two assumptions. Prices rise over time and borrowing gets cheaper. Both assumptions have been shaken. The system was built around that mindset. Now everyone, homeowners, investors, lenders and politicians, is adjusting to a new reality. The coming months will be crucial. Data releases, inflation figures, rate decisions and policy announcements will all influence direction. But one thing is certain. The housing market sits at the heart of the British economy, and when it trembles, the whole country feels it. Let me know in the comments what you're seeing in your area. Are homes selling? Are rents rising? Are you holding off buying or planning a move? Your insight matters. And if you found this breakdown valuable, make sure you like the video, subscribe to the channel, and stay informed. Because in a market this volatile, knowledge truly is power.